I think I make two quick impressions from seeing the listing. And many times there are good properties that the listing just doesn't do it justice. And then
Yeah, I find that sometimes if people who are listing it aren't necessarily investor mind or investor focused, they leave out some of the details in the listing, which might be very pertinent or important to somebody who is going to be like an investor. And oftentimes when you are in those listings as well, you can sometimes have a little bit less competition because if they advertise it like, you know, like
side entrance, good ceiling height in the basement.
Then you're going to have all the investors coming to look for it.
That's right.
So if you can take the time and kind of seek out ones and be like, oh, that might actually work, even though it's not advertised. That's when you can maybe be in a little less competition and still obviously get fantastic properties because this is probably one of the best basement apartments I've been in personally. Anyway, so.
No, this is going to be sweet once it's done. Like,
this is awesome.
I'm so pumped for this guy. And the refinances are starting to come back in. So when he bought this place, we didn't know what his refinance would be. We thought maybe 500.
Now, no problem.
Yeah, now no problem at all. So he's, it's actually a good lesson. Every one of my clients that pulled the trigger during COVID and shortly after have done really well, right?
I've had a couple clients actually did the same thing. They pulled the trigger right kind of like during that uncertainty time. And things have worked out really, really well for them. Obviously, you know, there has to be a few factors going for you to be able to do that. But if your personal finances are in order and the deal's there, sometimes it can work out even better for you than now because getting a property for under 400 that you can actually duplex is almost impossible right now.
It's a lesson because the one thing that I heard a while back, right? One of my mentors, they were saying during 2008, they were realtors as well. They were helping investors. They had a list of like 10, 12 people that told them, let us know when the market cools down. We're going to buy a property then. And they had this list of investors. And then in 2008, in Canada, we didn't quite get the same crash as the States, but there was a little bit of a calmness, right? Similar, I would say, almost to what we experienced during COVID. And of the 10, 12 people, only 2 of them were willing to pull the trigger. The other 10 were like, oh no, the sky's falling down. We can't invest now. It's a lesson. If you're not ready to invest in good times and your thought process is that you're going to wait till prices get cheaper, I highly recommend to reconsider that thought. Because right now when interest rates are low, things are relatively calmer, right? You can get tenants. There's not as much uncertainty. I mean, with COVID, there is uncertainty, but right now we're in a bit of a calmer time. If you're not ready to pull the trigger now, and what you're telling yourself is that you'll wait till things become worse, just reconsider that you may not be fully aware of how you will react to that situation, right? Because it's tough to pull the trigger to buy a property when there's uncertainty. What most of the investors I talked to who didn't buy, they were kind of saying, we're just going to wait for the crash to happen. We're going to wait for things to get worse. When they were saying that, that was the time to buy.
It's kind of funny, like you can never, whether it's in any kind of investing, right? Whether it's the stock market or real estate or whatever you're going to put your money into, it can really be a dangerous game to try and time the market to hit the bottom out, right? If you're going through and if you're a smart investor, in my past clients and what I've seen out there so far is that if you're ready, if you're in a position to make the investment and the investment makes sense, it's typically good to go forward. Because if you're like, oh no, I'm going to wait for it to go down, for instance. I've had a few clients that were kind of looking at the beginning of COVID and they said, and almost a similar thing that you are, where they were looking, they had a couple deals that came in front of them that were actually, in hindsight, like right now, were unbelievable deals, like 50 grand less than you're paying for right now. But because of COVID, they're like, you know what, I don't want to pull the trigger. I think it's going to crash. And now they're coming back in trying to buy, and they're trying to buy those same properties at 40, 50 grand more. And, you know, and it was way more competition too, right? So the investment still made sense for them then. Financially, they were okay. And from a numbers basis, it was a sound investment. But they were trying to get that, unbelievable home run deal because they thought COVID was going to take it down. And now they're basically just trying to get a good deal. Right? As opposed to just like, that was a great deal before, but they're like, oh no, I'm going to get the best deal, right? I think it's kind of a good thing for us as, you know, as advisors as well as for investors to, something to just consider and learn. Like, at the end of the day, try and just take the emotion out of the purchase and just think about it purely based upon a factual thing. Are you ready to make an investment? Does the investment make sense?
Yeah.
When you try and get a little bit greedy, I guess,
Yeah.
it can nip you in the bud, which I think is pretty obvious in all aspects of life, right?
Yeah, and I think like the way you make decisions counts, right? If you're waiting for a good deal, but without any parameters on what a good deal is, it's you're taking a shot in the dark, right? You don't know when you have something good in front of you because you haven't defined what is a good deal to you, right? So for us, like in my own investing, if a property cash flows, that's a good deal. Now, you want to consider that it's in a good area, you're going to get good tenants, and it has to be in a city that's growing and all of that. But if you can create positive cash flow, that's what I consider a good deal, because there's a lot of investment properties that don't produce positive cash flow, which I don't consider good deals, right? So to me, that's my differentiating factor. If you have an abundance of properties in front of you that cash flow, then sure, pick the best one for yourself, right? That's perfectly fine. But what we saw in a funny way, March, April, May were relatively busy months. Now it's way busier for us, obviously, but we were still busy back then. But it was with the clients that were just ready to move forward, regardless of what was happening around them, because they knew, hey, as long as I can make positive cash flow, I can move forward on this deal. And yes, the value of the property may go down, but they were okay with taking that risk because they knew, hey, it's not a lot of competition. We can negotiate a little bit on the price. We can get some positive cash flow. And what happened was obviously unexpected to all of us.
Nobody expected this to happen.
Nobody expected this, but the buyers that bought with the understanding that prices could go down, and that's okay. Like they could have bought at 400 and prices could have gone down to say 360, but they were fine with it. They were going to create a duplex, or if it's a single family home, they were just going to rent it out, and they were ready for that. And because of them being ready for that, having that metric of we're going to make positive cash flow, and if we can, that's a good deal, they moved forward. And a few of them are now up 50, almost 100 grand.
Just nothing. Yeah.
Yeah.
And I think we should kind of touch on a little bit there too, is these investors aren't like flip investors or short-term investors.
Absolutely.
Right? When you invest for the long term, which the majority of our investors are buy and hold investors, it's not like they're not concerned about a little blip in a thing. They're looking for the long-term span, right? It's like they know that over the course of the holding period of this investment, even if it goes down in the next 6 months to a year, over the course that they're going to hold the investment, it's still going to maintain and hold its value, right? Because the underlying fundamentals are there. When you start to try and, it's not really investing when you're kind of looking at short term, right? It's more of a speculation or almost like a gambling, really, because in short term, nobody can really predict what it is.
That's right.
The underlying economic fundamentals can give us a good outlay for the long term. But if you're staring there in the short term and trying to just time markets and get in, get out when it's high and low, that's where it can become very dangerous, right? And it's in my opinion, it's not investing in that, right?
Yeah. And even some of the greatest investors in the world, they don't time whatever markets they're in. Like Warren Buffett is a prime example of this, right? He really advocates for investing over longer periods of time and highly recommends not day trading, for example, in the stock market, right? So the same is in real estate.
Like flipping is like day trading and investing, right?
Basically, right?
It's kind of like that.
Yeah, sometimes it really works out, right? We've had a few clients where they buy, and by the time they're ready to sell 6 months later, the market has also moved up and they've bought good deals. So it works out for them. But it's one of those things where it's never guaranteed, right? The market can move the other way in a short period of time. Like if someone bought, for example, last November and was trying to sell it in March, that would have been quite a difficult time for them, right? But yeah, it's one of those things, the more time and the more patience you have, you're able to really get a good result, right? So yeah, I think it's a good perspective to have when it comes to investing, because it's funny, everyone wants to make money quickly, right? Everyone wants like that deal that's like 50 grand under market value.
As soon as it closes, I've already made 50 grand.
Exactly, right? But it's so funny because if you look at the people who really made a lot of money in real estate, they just own good properties for long periods of time, right? This one guy that comes to mind, he owned a few apartment buildings in Toronto, and he just when I met him, had these 200-unit buildings that had a ridiculous amount of equity, that cash flowing a ridiculous amount, and he wasn't trying to get the deal and just get out of it quickly. No, he was in it for, like, he was investing since the 1970s, right? So he just gave it time, bought a few properties. When it made some money, he would either refinance or sell them and buy something bigger, and just compound it over decades, basically. And like it's in a funny way, it's the hack, right? If you really want to make a lot of money, just be patient. Figure out a strategy and be patient, right? And take action, right? Put in the work. There's a correlation between the people who are really willing to be patient. They get lucky, like especially when you look at the BRRRR strategy. We have some investors coming to us saying, find us a property that will be a complete BRRRR right off the get-go. From the purchase price, we want to know that we can get every dollar out. And most of the times, we don't find them a great deal. It's hard to actually find those kind of deals, so they never end up pulling the trigger. Then you have a client like John and Cynthia here who bought this home. They bought it at $385. They had no expectations. They're like, yeah.
Because the market could have went down and their BRRRR could have really
gone backwards, right?
Yeah, could have went backwards. But they knew that the property was still underlying the fundamentals. Yeah. It was a good investment, right? It was going to cash flow. If they couldn't get their money out, they were still going to be okay for their personal side too, right? It's not, we're not just telling you to go buy a property and, you're not going to be able to put food on the table. Like, they were sound for themselves.
That's right, yeah.
They knew that the property was going to cash flow, and if they could get their money out, that was a bonus.
Exactly.
And now that bonus turned into a
certainty,
huge bonus, right?
Exactly.
Where they're actually collecting money. It's almost going to be like a perfect BRRRR. It'll be pretty close to
I think so, because they bought it for $385. They're going to put in maybe 70 to 80 grand into this, and they're going to refinance probably around 570, right?
So, yeah,
they're probably going to take all their money out, and they'll own a property free and, like, without any of their own money left in the deal.
But if they tried to wait or try and
find the property,
perfect BRRRR, where would they probably still be looking for a property?
exactly. So, yeah, this is one of those situations where if you focus on the right fundamentals of quality properties, good cash flow, then over time, all your properties will become BRRRRs. Like the Niagara market for the last year went up like, 12-15%, right?
In Wellington, it's went up 20.
20, right? So now we're not guaranteeing that's the next year, but over time that will eventually happen, even if it's 2 years, 3 years, 4 years, 5 years.
If you look at a graph, right?
Yeah.
The graph goes like this. It goes like this, but the start is here and the end is here, right? There's cycles throughout that.
Yeah.
It's just like the stock market, right?
Yeah.
If you look at a graph, there's cycles throughout it, but the underlying fundamentals, if you're buying good stocks or good properties in good areas, and it makes sense to buy it when you're buying it because it's going to cash flow for the purchase price, then over time, it'll work out well for you typically, right?
And the difference with real estate compared to the stock market is every time properties go up 20%, you get to take out your down payment and go buy another property. You get to take out every dollar you put into that first one. That's why you hear people who have 10, 15, 20 properties, they don't just start investing with $2 million in the bank, right? They just buy the first rental, let it accumulate some equity, and then when they can pull it out, buy the second, let those two, buy the third and the fourth, and just let it compound, right? But it really takes time. And I feel if you're willing to be patient, then the world's the oyster, right? You can go really, really far in this. But if you're trying to just get everything up front, then you're likely not even going to buy the first property in many cases, right? So, yeah, I think it's just a good lesson to learn. Like even ourselves, right? We obviously want to buy properties that have the upside potential, but even for us, sometimes we need to like tell this lesson to ourselves that, hey, when there's a good property in front of us, we need to take action without, like my last purchase on Fitch Street, for example, I bought it. I'm under renovation right now. I literally don't know what my refinance is going to be. But again, I focus on the fundamentals. It's a good property in a good location. I know I can get some solid rents for it. The renovation doesn't seem too bad. So I just focused on that, and I'm just going to let it play out. Whether the refi comes back at 500, if it comes back higher than that, bonus, right? If it comes back a little bit less than that, that's fine. I'll get my reno money out. I'll wait a little bit. So
I kind of like to, I'm a big sports guy. So I kind of always like to put things into analogies, right? And so if you think about baseball, right? If you're the kind of guy who always wants to swing for the fences and hit home runs, you're going to strike out a lot.
Yeah.
Right? You're going to be sitting in there, you're going to watch pitches go by, you're going to strike out, and you're never going to get on base.
Yeah.
Right? Whereas if you're that guy who's just, okay, how can I get on base? How can I take a walk? How can I slap a single out there? your on base percentage is going to be good. You're going to in turn drive in more runs. It might not be as glamorous as that, guy who hits the big bomb over there to the walk-off home run.
Yeah.
But it's more consistent over time. And if you look at, managers for baseball teams or anything like that, those guys are super valuable.
Yeah.
And it's if you can take that kind of mindset to your investing, it's like, okay, I don't need to have a home run. I don't need to swing for the fences. How can I get a base hit? How can I get in the game?
Yeah.
How can I make something that's going to be good for me? And kind of keep plodding along.
Yeah.
And just allow real estate to take over and allow that to propel me forward by making sound decisions based on good fundamentals, right?
Yeah.
So I don't know. So everyone thinks of things in a different way. I come from that kind of sports background, so for me, it's really easy to kind of think about it like that. And sometimes that can help people. So
I think that's super valid, right? Like I have a client that has bought 4 single-family homes, not even duplex conversions, just down payment, just rent it out, not do anything to it. And he's literally on some of these deals up 40, 50, 60,000. It's been like a year and a half, right? So it's like, I love the duplex conversion. I love the ability to create value. But for some of our clients, it's better for them to just buy a single family home, rent it out, let it work for them, right? Because maybe they're not in the position where they can manage a renovation or they have the funds to even manage a renovation and to get exactly
right? Like how much are you said he's putting in here again?
Like 70, 80,000, right? So these are big projects which when you're ready for it, it's great. But you know what? It's okay to buy a couple single family homes and then get into this after, right? There's no perfect way to do this, right? If you feel your comfort level is, let's buy a townhouse or a semi-detached home or a simple single family home and just rent it out, as long as it produces positive cash flow, again, that's our key metric, then you're good, right? Like if that allows you to get started, over time you'll build enough equity that you decide, hey, maybe you go back to some of these properties and put in basement apartments, or maybe if the property doesn't allow for it, at that point you sell it, you take in your gain, and then you redeploy it into a property with more potential. But there's no perfect way to do this, right? Like even in my own journey, I bought some single family homes, then I bought some student rentals, then I bought like a fourplex, a duplex conversion. So I've gone all across the map, but it shaped me into the investor I am today, right? So taking action many times is much more valuable than coming up with the perfect plan, because how many people do we know that have the perfect plans, but they've never taken action? There are some sad stories, actually. Some investors have been waiting since 2008 for a market crash, and
it hasn't happened yet. And how many properties could they have bought with the 20 grand they had in 2008 if they would have kept rolling it, right? Whereas now with 20 grand,
you can't do anything, right?
Unless you're buying a 5% down property, you can't do anything, right?
Yeah, absolutely. And literally, property prices have doubled since 2008. So if you bought just one property,
the last 5 years in Welland, it's went up over 100%.
Dang.
Right, and this is 2020, so that's 2015. You want to keep going back. I don't have the numbers in front of me, but I know it didn't go down from 2008 to 2015.
That's right.
That much I do know.
That's right. Yeah. So hope you found this helpful, and if you're on the sidelines, on the fence, take action. It'll serve you well.